Today, after the monetary binge, what? Hello again, it's Martin North from Digital Finance Analytics, who I've noticed post covering finance and broad news with a distinctively Australian flavour. In this week's market review, we consider the hangover coming as the punch bowl of cheap funds is taken away. And we start as always with the US, go across Europe and Asia, and end in Australia. Why? Because, like it or not, our fate is largely determined by what happens in the US, which drives the price of money via the US dollar, and China, our main export partner. The US FOMC raised interest rates back in June by 75 basis points, and last month the US central bank also started reducing the size of its enormous balance sheet. Until September, the Fed will be cutting $45 billion a month from its massive holdings, and it will increase that to $95 billion, almost twice as much as it did in the previous episode of quantitative tightening. So the value of the Fed's assets has already peaked, reaching $8.95 trillion in mid-May 2022. But although the Fed is tightening its monetary policy, its stance remains accommodative. According to the Taylor rule, the federal funds rate shouldn't just be between 1.5 and 1.75%, but it should be at least above 5%. So the US central bank remains behind the inflation curve, and it would have to raise interest rates much further to combat high inflation. But in the previous Fed tightening cycle of 2017-19, which by the way led to the repo crisis, forcing the US central bank to reverse its stance and to cut its interest rates. So the question is, will they do it this time? Given how fragile the financial system is and how much the debt bomb is ticking in the American economy, it's almost certain that the current monetary policy tightening will lead to a sovereign debt crisis or another kind of financial crisis if they were to do that. So, as the tightening continues, the debt servicing costs and the share of non-performing loans will increase, worsening the financial situation. So the question is, how high will the Fed go? And in fact, that was the question of the week and why the markets were so volatile during it. Some were saying 100 basis points next time or 1%, but known hawks at the Fed, including Governor Christopher Waller and St. Louis Fed President James Bullard, both said they favoured just 75 basis points next time. The US dollar remains very strong, of course, and is largely a flight to safety, according to Standard Chartered Bank head of global foreign exchange Steve Ingler. The problem is, until we get to see some light at the end of the tunnel with respect to either inflation coming off or gold prices coming off because of supply creation rather than demand destruction, it's hard to call a top to it. The DXY was down 0.52% to 107.98. And on Friday, US stocks closed sharply higher, ending several days of sell-offs, with a rebound fueled by upbeat earnings, strong economic data, and easing fears of a larger-than-expected interest rate hike by the Federal Reserve. All three major US stock indices posted solid gains, with financials leading the charge in the wake of Citigroup's earnings beat. This reversed Thursday's sell-off, which had been driven by downbeat guidance from JP Morgan and Morgan Stanley. The S&P 500 and the Dow both snapped 5-day losing streaks, but all three indices ended below last Friday's close. We are still below the downward sloping trend line, said Sam Stovall, Chief Investment Strategist at CFRA Research in New York. One day does not a new trend make. Consumer prices in June showed the highest annual growth rate since 1981, raising the chances that the Fed could lift that Fed rate by 100 basis points. But economic data released on Friday surprised the upside, with stronger than expected retail sales, an uptick in consumer sentiment, and lower inflation expectations and cooling import prices. Retail sales rose 1% last month, according to the Commerce Department, and data for May was revised up to show sales falling 0.1% instead of 0.3% as previously reported. Retail sales increased 8.4% on a year-on-year basis and are 18% above their pre-pandemic trend. While the retail sales data was applauded, economists were cautious, pointing out that a large reason for the gain was from the surge in the price of gasoline. Yes, consumers are spending more, but they're not taking home the same amount of goods. First Trust said in the note. Adjusted for the Consumer Price Index, retail sales declined 0.3% in June. But following the report, economists at Jefferies pointed to the falling gas prices, signalled optimism of further boost in consumer spending that could set up the economy for much stronger GDP growth in the third quarter. Separately, consumers tempered their inflation expectations in July, according to the latest report from the University of Michigan. Economic indicators are not consistent right now, said Tim Grisky, senior portfolio strategist in New York. They are positive and negative, which shows we're in a period of transition, or perhaps I would say confusion. But the Dow Jones Industrial Average rose 2.15% to 31,288. The S&P 500 gained 1.92% to 3,863, and the Nasdaq added 1.79% to 11,452. Citigroup bucked the trend among big bank earnings reports as its quarterly profit beat expectations, sending the stock up 13.2%. Wells Fargo said that its quarterly profit nearly halved due to increased loan loss provisions and a weak mortgage business. Still, its shares rose 6.2%. And even JP Morgan, which rose 4.6%, and Morgan Stanley, which rose 4.5%, reversed yesterday's trends. The S&P Banking Index jumped 5.8%. That's its biggest one-day percentage surge since January 2020. And BlackRock rose 2%, even after the world's largest asset manager posted a steeper than expected profit drop. And of course, there's more next week, with scheduled earnings releases from Goldman Sachs, the Bank of America, International Business Corporation, Netflix, Tesla, and Twitter, and an assortment of heavy-hitting industrials. Technology continued to uptrend, led by Amazon and Meta. The latter was up more than 4%. Amazon was in the spotlight after it said 300 million items were sold during its annual Prime Day sales event. Prime Day results make us incrementally more confident in the strength of the consumer and their willingness to spend post-pull forward in COVID demand, and as a result, Amazon's forward top-line growth, Morgan Stanley said. Twitter gained more than 3% as its case against Musk for terminating its $44 billion deal to take over the company, allegedly without cause, is expected to get underway on July the 19th. There are a range of possibilities that can come from the Delaware court, including settlement, breakup fee paid, deal enforced, and a myriad of other outcomes, Wedbush said in the note. And the second quarter earnings season is now well underway, with 35 of the companies in the S&P 500 having reported. Of those, 80% have beaten street expectations. Analysts now expect aggregate year-on-year S&P 500 second quarter profit growth of 5.6%, which is still down from 6.8% at the beginning of the year. The yield on the US 10-year note slipped 6 basis points to 2.989, and the 2-year was at 3.1305. So the recession is still being signalled by the inversion in the yield curves. Bill Adams, chief economist for Comerica Bank, said the outlook is as clouded as ever. The US economy is close to stalling out, and one more big shock would be enough to push it into recession. That shock might come from an energy crisis in Europe in the winter heating season, which could send US natural gas prices sharply higher, or from spillover from China's weakening economy. In the face of these headwinds, the risk of recession is roughly a coin toss between now and the end of 2023. On the geopolitical front, meanwhile, Italian Prime Minister Mario Draghi reportedly isn't willing to reconsider his decision to quit. The Italian president on Thursday urged the former European Central Bank president to return to Parliament next week to see whether he can shore up support for his administration. The news comes ahead of a pivotal week for Europe, with many watching whether Russia will in fact resume full gas supplies to Europe following maintenance work on the Nord Stream pipeline. The European Central Bank is also expected to deliver its first rate hike later next week. And yet, European stock markets traded higher on Friday, ending a difficult week on a positive note despite disappointing Chinese growth data and that uncertain political situation in Italy. The DAX in Germany traded up 2.76% to 12,864. The CAC 40 in France rose 2.04% to 6,036, and the UK's FTSE climbed 1.69% to 7,159. In corporate news, Aston Martin stock soared over 15% after the luxury car maker announced a £653 million funding package in which Saudi Arabia's public investment fund will become its second largest shareholder. And Burberry stock fell 7.2% after the British fashion brand announced a drop in sales in China. That's a key market of 35% in the first quarter. And TomTom stock rose 8.4% after the Dutch navigation and digital mapping company confirmed its 2022 revenue outlook despite strained supply chains. Oil prices fell on Friday and remain on course to end around $100 a barrel for the first time since early April, after the Chinese growth data raised concerns over a global economic slowdown. And US President Joe Biden flew to Saudi Arabia on Friday in an attempt to get his Gulf allies to pump more oil and thus lower prices. But he might find this difficult to achieve as spare capacity at the majority of the members of the Organization of the Petroleum Exporting Countries, or OPEC, is running very low. Oil prices are edging higher again after falling around 20% over the last month in response to increasing recession fears, noted Craig Erlam, analyst at online trading platform Onya. The soothing words of Bullard and Waller reassured everyone that 75 basis point remains the base case for rate hikes, he added. Brent has moved back above $100 a barrel on those comforting words, but promises to remain choppy amid a tight market and ongoing recession concerns. WTI crude futures traded lower to $97.59 a barrel. That's down over 8% on the week, while the Brent contract rose to $100.99. That's over 5% lower on the week. Looking to the week ahead, analysts say US crude prices were at an inflection point of either breaking out to $106 and beyond or falling back to set a new multi-month low of $83. The euro-US dollar edged 0.1% higher to 1.0026, and gold futures fell to 1,705. In fact, gold survived another assault on $1,700 today after briefly dipping below on Thursday. A stronger dollar and higher yields are wreaking havoc on the yellow metal, even in this risk-averse environment. The battle raging between inflation and interest rates and a recession is creating quite the tug-of-war at times, and we will see that continuing in the coming weeks, with the economy seemingly viewed as teetering on the edge of recession amid current rate projections. And a move below $1,700 would be a psychological blow, but $1,680 could be more significant. Asia-Pacific stocks were mostly up on Friday as the expectations of that 100 basis point US interest rate hike in July receded. Japan's Nikkei 225 closed up 0.54%, 26,788. China's lockdowns appear to be behind the staggering 7.5% decline in Japanese industrial production in the month of May. Japan reported that its tertiary sector services was a little stronger than expected, rising by 0.8% in May. And separately, the Prime Minister has not wasted any time after last weekend's election. He's calling for restarting as many as 9 nuclear reactors by the winter, which could provide around 10% of the country's power needs. Imported energy, natural gas and coal, is responsible for a significant part of the rise in imports and hence the deterioration in Japan's external balance. Getting more nuclear power online would likely help ease the terms of trade shock. And lastly, the Bank of Japan meets next week, and while policy is likely to change, the central bank may shave its growth forecast and lift its inflation projections. South Korea's Kospi edged up 0.37% to 2,330, and Hong Kong's Hang Seng was down 2.19% to 20,297. And China's Shanghai Composite was down 1.64%. Fears of a global economic slowdown has plagued stock markets for much of the week, and further evidence of this emerged earlier on Friday after China's economy contracted sharply in the second quarter. Data from the National Bureau of Statistics showed that China's gross domestic product grew by 0.4% in the second quarter, and its GDP fell 2.6% from the previous quarter, compared with a revised 1.4% gain in the previous quarter, highlighting the toll on activity in the world's second largest economy from widespread COVID lockdowns. Goldman Sachs downgraded its forecast for China's full-year economic growth to 3.3% from 4% after that official data. The June data was more solid, though, as the reopening after lockdowns and the government stimulus lent support. Industrial output rose 3.9% year over year after a 0.7% increase in May. Autos, solar power batteries, telecoms rose sharply. Retail sales rose 3.1% year over year after a 6.7% drop in May, and auto sales were notably rising 13.9% year over year after a 5.9% contraction in May. Surveyed jobless fell to 5.5% from 5.9%, and fixed asset investment increased 6.1% year to date on a year-over-year basis, slightly slower than the 6.2% pace in May. Manufacturing investment rose 10.4% and infrastructure rose 7%. However, property investment fell 5.4% year over year after a 4% decline in May, and home sales are off almost 29% year over year. Chinese regulators' assurances of help in delivering projects in the property sector on time failed to convince some home buyers, threatening to stop mortgage payments, and investors continue to sell shares in embattled developers on Friday. A growing nationwide home buyers boycott has rekindled investor concerns about China's slumping property sector, which accounts for a quarter of the economy, and raised fears banks could face hefty write-downs. Up to 1.5 trillion yuan, or $220 billion of mortgage loans are linked to unfinished Chinese residential projects, according to ANZ estimates. Shares in Chinese property developers extended losses even after the banking watchdog vowed to strengthen coordination with other regulators to guarantee the delivery of homes, and at least 10 banks said mortgages related to risky projects are relatively small and risks are controllable. The regulatory assurances came as home buyers' threats to withhold payments for stalled property projects have proliferated in official and social media in recent weeks. In a rare show of public discontent, the Hang Seng Mainland Properties Index tumbled 5% on Friday, and that dragged the Hong Kong benchmark down. Among those hardest hit, shares in Shanghai-based CIFI Holdings plunged 14.3%, while top developer Country Garden Holdings fell 8.6%. A $2026 bond of Yuzhou Properties traded at 6.354 cents on the dollar on Friday afternoon. That's down from 6.861 the day earlier, while a 2024 bond from Xinhan Real Estate dropped 11.125 from 12.425, and onshore, a yuan bond from Powerlog Real Estate and Sino Ocean Group slid 20% and 16% respectively. Government assurances were not enough to convince at least some home buyers, threatening to stop mortgage payments. One home buyer in the east central Chinese city of Zhenhu said, "We don't have any other way to voice at the moment. We're still in a desperate situation." In the letter issued to the home buyers, the housing regulator said it, along with other government departments, had reached an agreement with the developer and the contractor that some funds would be paid to resume construction. Earlier on Thursday, local regulators in Jian, a city in West China, said they would tighten oversight of escrow accounts and make sure money put down by home owners isn't transferred illegally by property developers. The widening mortgage boycott has added to worries about a prolonged slump in China's property market and the risks of possible social unrest. Data on Friday showed property investment, home sales, and new construction starts continue to slump. Things will get worse before they get better, said Zaya Zhang, China finance analyst for Chinese research group Gavikel Dragonomics. China has been determined to curb the leverage taken on by property developers, and the government will still try to refrain from providing liquidity to them in a big scale. It will take time for some more targeted measures to be issued, she said. As property firm stocks weakened, a sell-off in banking shares also gathered steam amid investor concerns that the mortgage revolt may snowball. An industry gauge tracking mainland banks closed down 1.6%. And Tommy Zi, head of Greater China Research at OCBC Bank, said the mortgage repayment suspension is turning from a liquidity crisis for property developers to a financial crisis, and it has made it urgent for the central government to step in. Now, down here in Australia, Rio Tinto fell more than 4% at one stage in early trade on Friday to $91.91, extending falls on Wall Street overnight, while the iron ore miner said it had suffered increased absenteeism in the past fortnight, and as it warned higher interest rates to fight inflation would affect demand. Its decline contributed to the end of the S&P ASX 200's 3-day winning streak, as the benchmark tumbled more than 1.5% in the first hour of trading before paring back its lows on worries about tumbling commodity prices and a weaker than expected Chinese second quarter GDP report. The S&P ASX 200 ended the day 0.7% or 45 points lower at 6,605, pulling the index to a weekly decline of 1.1%. And the All Ordinaries dropped 0.7% to 6,798. Materials stocks fell across the board, pushing the sector 3.2% lower, with BHP dropping 3.5% to $36, Fortescue fell 6.2% to $16.30, and South 32 declined 3.7% to $3.40. Iron ore futures dropped overnight, with the benchmark price in Singapore crashing to the lowest in 8 months as fears grew that demand for the steelmaking ingredient in China will remain depressed in the short term. And benchmark copper on the LME fell 2.3% to $7,160 US a tonne after touching a 20-month low of $7,059. Rio Tinto shares did recover somewhat during the day, ending 2.9% lower at 93.27. Consumer staples and healthcare stocks were the two indices that led trading on Friday. Among the best and worst performers on the index, shares in investment manager Pendal plunged 7.9% on Friday after the group reported worse than expected outflows in the June quarter from its managed funds. But shares in WiseTech jumped as much as 7% in early trade after the logistics software provider lifted its annual earnings forecast, pointing to stronger top-line growth and improved cost savings. WiseTech ended the day up 3.4% to 44.13. Banks were mixed, with ANZ down 1.32% to 21.64. Westpac was down 0.2% to 19.90. CBA was up 0.05% to 93.27. And NAB was up 0.53% to 28.45. But Macquarie was down 1.76% to 167.99. And the Aussie dollar remains weak against a strong US dollar, but it was up 0.67% to 67.92. And finally, cryptocurrency lender Celsius Network filed for Chapter 11 bankruptcy. That's the latest casualty in a $2 trillion crash that's wiped out some of the industry's biggest names and exposed hundreds of thousands of individual investors to steep losses. Celsius, which has more than 100,000 creditors, said it took the steps to stabilize its business and work out a restructuring for all stakeholders. The filing was made in the Southern District of New York and listed Alameda Research, the trading firm co-funded by crypto billionaire Sam Bankman-Fried, among major creditors. The platform held about $4.3 billion of assets against $5.5 billion of liabilities as at Wednesday, according to the court papers, and the company has been trying to obtain new financing from third parties, but those talks made clear that a bankruptcy filing was necessary. And in crypto land, Bitcoin was at 20,779 and Ether was at 1,227, still signs the crypto sector remains in deep water. More broadly, the volatility will continue to rage, with more bear rallies likely as we grind lower. And frankly, who knows where the bottom is? At the moment, it's impossible to say. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.